Well, the escalating conflict between Israel and Iran has caused the price of oil to jump to its highest level since April. Traders are concerned the conflict could spread to a wider Middle East region, threatening the transport of oil tankers through the Strait of Hormuz. Israel's targeted attacks on Iran have destroyed a fuel depot and an oil refinery near Tehran. Now, Iran reportedly holds the world's second largest proven natural gas reserves and the third largest crude oil reserves. Here's a look at the price of Brent crude oil over the past week. You can see it's up a bit over 12% to about $74.63 US a barrel. It's been jumping up and down a fair bit recently. Brent crude oil futures lifted 13% in a single day last Friday, and that's the largest increase since Russia invaded Ukraine in 2022. And for more on this topic, let's bring in Saul, Senior Energy Analyst at MST Financial. Saul, thanks for your time. Oil prices obviously surging, the conflict escalating. I mean, how much higher could oil prices go here?
Well, we must keep in mind the price rise we've seen since Friday is not based on any actual supply disruption, because that hasn't happened at least yet. So this is just a risk premium due to the potential scope for a supply disruption. Now, it's important to keep in mind the attack that we saw that Israel conducted against Iran on Friday was at the most severe end of expectations of what an attack could look like. And it's escalated over the weekend to the point that both sides have targeted each other's energy infrastructure, but only domestic energy infrastructure. So their exports, which is critical to global markets, have not been impacted yet. So the risk here is twofold. One, could we see Israel directly attack Iranian exports, for example, on a Kirk Island, which could take 1.5 million barrels a day off the market? But also, could we see Iran target Western oil interests in Gulf states such as Iraq, which could also knock a few million barrels a day off the market? And just in that kind of scenario, you could see oil approach $100 a barrel. The most severe scenario, of course, would be if Iran looked to shut down the Strait of Hormuz, where 20% of the world's oil and 20% of the world's LNG pass through. That could cause an energy crisis such that we've not actually seen before. It would exceed the extremes we saw in the wake of the Ukraine war in 2022. And the reality is our energy markets globally have low resilience. Strategic stocks, particularly in the US, are at record low levels, and we're not well placed to actually deal with a major supply disruption like that if it was to occur.
Yeah, you've modelled quite a few potential scenarios of what might happen, but just reflecting on 2022 and the supply shocks then, what sort of price impact did it have on the oil market back in 2022, and what sort of similarities are we seeing today with what's happening in the Middle East?
So 2022 saw oil head to around 130, and more importantly, gas got to almost towards $100 an MMBTU, which is about 7 times what it is today. And that was in the face of very little supply disruption to oil, but a lot of gas being withheld from the European market. Even then, Russia only supplies about 10% of the world's oil. The 20% of the oil flows through the Strait of Hormuz right next to where Iran is. So the scope for the size of the disruption here could be much larger than we've seen before. But there's a multiple end games here. If we do see a deal which returns to an actual nuclear deal with Iran as a result of this military pressure, that would actually be quite bearish for oil. Most of the other scenarios, though, are going to see at the least much more severe sanctions on Iran, if not direct military attacks on Iranian infrastructure and or middle oil infrastructure across the Gulf, including the Strait. There is one last scenario, though, where if we actually do see regime change in Iran, which is a possibility rather than a probability at this point, and it actually was to evolve to a more moderate government that welcomes Western investment again, that could actually see Iran return to the global market as a major supplier, which it hasn't been since the 70s. And that would be actually structurally very bearish for both oil and LNG over the medium to long term. But right now, when we look at the scenarios, most of them are pointing towards structurally bullish factors as a result of this conflict, which is only really looking to escalate over the coming weeks.
All right, Saul. Now, just shifting topics to the Santos deal. Obviously hasn't gone through yet. Treasurer Jim Chalmers will need to approve it. How much pressure do you think there is around this deal? Because we know Santos owns a lot of infrastructure here in Australia. Could the Treasurer put some concessions on this deal?
Well, this is a major opportunity for the government to actually extract concessions regarding domestic gas, as it coincides exactly with when they're reviewing their East Coast gas policy. So it's one thing for the government to try and retrospectively impose things like a reservation policy, but it's quite different if they try and get their policy wins through as conditions to allowing a deal to go through. So there's an opportunity really here for Labor to undo their mistake of over a decade ago when they approved the GLNG project without any reservation policy. And so that's an opportunity for the government. That said, there's some other factors at play here. It's critical infrastructure both on the East Coast and West Coast. Also, do we want a lot of our gas supply under the control of a foreign government which has their own domestic priorities and could warehouse Australian assets? You know, we've seen in the past major international investors come to Australia, very keen to invest initially, but years later are actually standing on the hose. And so the government needs to be really careful with its approvals here to make sure that this is going to be the interest of our resource development going forward, not just in the near term, but for decades to come.
So if it does get approved and there are concessions in place, then could it result in cheaper gas prices for manufacturers and big customers here in Australia?
Well, I think the opportunity is right now there for the government to help achieve that outcome. Something interesting in this bid is Carlyle, the private equity firm, is involved as well. I think if we need to ask why are they involved and could there be scope to actually spin out some of these domestic assets to a player such as Carlyle? It's got therefore have less regulatory scrutiny from a firm perspective as it's not owned by a foreign government, and they'd be more encouraged to do engage in more development and growth over the next few years.
Saul Kavonic, great to have you on the show. Thanks very much.
Thank you.